Hello, Business 630 students. This is Professor Hassey, and this is our week 2 introduction or lecture video for the week. As you all know, we have a video at the beginning of every week and a video at the end of every week to highlight our key topics for the week. As you all know, this is a corporate finance class. And what's corporate finance without a little capital valuation and the time value of money? And that's our topics for this week. As I hope you're all getting familiar with our Blackboard platform, all of you have posted your bios for and company selections last week. The grades are posted to Blackboard, and I'll show you that in just a minute. Also this week, you are scheduling meetings with me, the professor, for about 10-15 minutes, just some one-on-one meetings to get to know me and and answer any questions or concerns of the course. So if you have yet to sign up for those professor meetings, you have one day, Thursday of this week, to do that. So please let me know and make a designation of a time for this Thursday to meet with yours truly. No graded work this week. Well, I guess there is graded work. If you do your professor meeting, you get points for that. But there's no case study work. Our case study will be posted this coming weekend, and it'll involve the company that you have selected for this course. And I'll talk more about that on my Friday update video. So our subject this week is the time value of money, present and future value. Now, I'm sure many of you have worked with this before in your undergraduate education and also in your own workplace education. And we're going to also define the valuation of bonds. And next week, we're going to talk about stocks to give us the basics of capital before we get into corporate strategies involving capital decision making. So let's take a look at our Blackboard and see where we stand here beginning week 2 of our course. Okay, as you know, the Blackboard is a way that we do our online asynchronous course, which is totally online, no remote learning. You do everything through the lectures and the videos posted to Blackboard. You do your own studying and then answer whatever the assessment is for that week. Speaking of assessments, if you click on every week, like here's week 2, you'll see the learning assignments for the week. In other words, what we'll be covering and what you need to be aware of for the week. As you can see, there's our lecture video, which is going to be posted today, April 11th. The topics and the chapters we'll be reviewing are chapter 4 and 5 of our textbook. Again, the textbook is not mandatory for this class. All the textbook materials and PowerPoints are included in every week of our platform. The only assessment this week is the student professor meeting via Zoom, which begins Monday through Thursday of this week. The schedule and the appointment schedules in the student discussion forum. And then once you complete this, this represents 5% of your course grade. So that's the assessments for the week. That's our plan for the week, and that's a good thing to see. Also, if you want a highlight of all our work in our class, you can go to the course syllabus and information, and there's all the important dates of our class. Actually, our case number 1 is coming up, which will be an APA format paper. Case number 2 is a spreadsheet format work, and case 3 is a PowerPoint format work. One of the key things of MBA study is to make sure you can present and interpret data and information in a variety of different formats, and that's what we'll be doing in this class. So again, going back to week 2, computer's a little slow today. Again, there's some lecture notes. There's going to be a spreadsheet. There's a spreadsheet that I'm going to be reviewing in my lecture this evening, which will talk about the time value of money and risk and return and all our important topics of the first week. And there's again our highlighted professor meeting in case you missed it in the discussion board. But you go to the student discussion board to fill out and select your time to meet with me. And as that comes up, you'll see the schedule is pretty set. We still have some students who have yet to sign up. And if you can do that as soon as possible. If you cannot make the Thursday, April 13th meetings, we can schedule something over the weekend. Just let me know your schedule. So there's all the key highlights of our Blackboard. If we go back to the front page, you'll see that your report card and you'll see your grade in this course up to this point in time. So if you've already posted the first week discussion posting, which was your bio and the company selection, and if you posted and already met with me in the professor meetings, you'll see your cumulative grade of those 2 grades thus far in the class. Now here's a video introducing the time value of money, one of our main topics for this week. And again, for a lot of you, this is probably kind of boring and a refresher, but at the same time, this is a good review of key things that we're going to be doing in the calculations of our course. So let's watch this video.
Or any basic finance courses, you've probably been exposed to something called the time value of money. So we hear this concept a lot, and it's something very important to the foundations of finance and to some degree accounting. So we want to talk about, well, what does this mean from a conceptual point of view? What is the concept here? What are we talking about when we say that money has a time value? So let's look at this through an example. So let's take an example here. Let's say that I offer you 2 options. Okay, now one of the options is going to be that I give you $100 cash today. $100 today. And then in the other option, we're going to say that I give you, let's change colors here again. Let's say I give you $100 1 year from now. 1 year from now. Now, let's just assume for a moment that when I say I'll give you the $100 1 year from now, that's certain. That's not something that I might not pay it or something like that. It's guaranteed. You either get $100 today or you get $100 1 year from now. But either way, there's no risk associated with it. You're going to get the $100. So let's look at these 2 options. Now, which would you prefer? Now, you might say, well, I just prefer the $100 today because I just want the money. I have something I'm already going to spend it on. But let's just forget about that for a moment. Let's assume that you don't necessarily have anything you want to buy, but you do want the $100. Well, you might think, well, I'm indifferent whether I get it today or whether it's 1 year from now. But let's think about this, because the money has a time value. Now let's illustrate this. So let's look at a little timeline here. So here in this option, we're getting the $100 right here, which we'll call this, that's today, right here. This is today. And then over here, this is 1 year from now. 1 year. Now let's go down to our other option, and we'll have a little timeline. And again, we've got right here is today, and you're not getting anything today. There's nothing here because you're getting it 1 year from now. You're going to be handed right here $100. Now let's think about things here for a moment. So when we get the $100 here today, what can we do with that money? Well, you could go out and spend it or something, but let's just assume that you didn't spend it. Well, what else could you do? You could invest that money. Now let's say that you invested in something and you ended up getting a 5% return. Let's say you took it to the bank and you got a 5% return on some kind of investment. Now, what's going to happen is that at the end of that year, you don't have $100 anymore. Well, what do you have? You're going to have 100 times 1.05, which is going to be, that's going to be $105. So we see that if you get the money today, if you get it sooner rather than later, there's a value to getting it earlier because it can be invested to earn a rate of return. And then at the end of the period, you end up having more money than what you started with. Now, when we look at the other option where you get $100 at the end of the year, you didn't have the option of investing it here because you didn't have the money. So when you get the money sooner rather than later, there's more value there because you can go ahead and invest the money and earn a return on it. So that's what we're talking about when people say that the time value of money. They're just basically saying that money is something that if you're looking at cash flows, cash flow today or cash flow in the future, a cash flow today, all else equal, the same amount is going to have more value because it can be invested for that return. So now you might be thinking, well, how does this have real world applications, or what do we think about? But let's say we've got some project that the firm is thinking about. That project, you might say, okay, well, we're going to buy this machine, and it would generate cash flows over a period of, let's say, 5 years. So you can look at these different years, and you can go and say, okay, here's year 1, 2, 3, 4, 5, and you can say, okay, well, we estimate that in year 1, if we get this machine, we're gonna have $100 in cash flow. In year 2, 175. Year 3, 200. 300, and then let's say in the last year it generates 50. But what you can do is say, okay, well, now we know we're estimating these cash flows, but now what we want to do is we want to say, okay, well, like for example, here in year 5, that $50, we can't just add all these together and say, okay, well, now we've got this sum and this is how much it's gonna generate from this price. We have to take into account that $50 5 years from now is not worth the same as $50 today. So what we're going to do is account for this time value of money. And TV, maybe not the best acronym I have there, but the time value of money, we're going to look at this and we're going to say, well, what if we can just go ahead and say we earn a 5% interest on all our investments? Then we can say, okay, let's figure out what that $50 5 years from now is worth in terms of today's dollars. And when we do that, what we're doing is called discounting cash flows. So we're discounting cash flows. So that 50 here, this is a cash flow in year 5. And what we're doing is we're saying, what's the rate of return we could have earned on money today? Let's say 5%, 7%, whatever it is. And then let's use that to go ahead and discount this number and say, so it's going to be something less than 50 because maybe it's 30 or 35 or whatever, depending on your discount rate, could have been invested today to get 55 years from now. So when we talk about discounting cash flows, what we're doing is we're using the time value of money concept and some other formulas that we're going to talk about in other videos to take future cash flows and figure out what are they worth today.
Here's a spreadsheet that highlights for our particular class and the strategies and work that we'll be doing in this 8-week class. This is some of the time value of money concepts that we'll be doing in our class. For example, let's say we make an investment in an asset, and that investment is $100,000. So we invest and purchase an asset for $100,000. We estimate that the cash flow, in other words, the revenue minus expenses, and the net cash flow generated off that investment over its depreciable life, which is 10 years, is $140,000. So we're going to be receiving profits and cash flow off this investment of $100,000 over the course of its depreciable life. If you guys remember that from accounting, depreciation, which is the estimated financial life of the asset, $140,000. The question is this a good investment? Well, remember, here we have an investment today and cash flows being received in the future. What is this future cash flow valued at today? And this is an example of what this video that you just saw called discounting cash flow. In other words, $140,000, what is it worth today? And the discount rate is the company's cost of capital, what it costs them to get the $100,000 to invest in this asset. And in this particular instance, it's 6%. So if we go to our formulas function of our spreadsheet, formulas, and go to function and go to financial, we're going to look for the calculation called net present value, NPV. There it is right there. And this calculation takes this future cash flow and discounts it back to today at 6%. So we type in 6%, and then we put in the values and just paint from year 1 through year 10, the depreciable life. That's in this case E7 to N7. And then we hit OK. And as you can see, the discounted cash flow is actually worth $96,122.63. Uh-oh, we see some problems. So if we take that difference, the difference between the investment and the discounted cash flow, we get a negative net present value of $3,800. In other words, this is a bad investment. Even though on paper, the first look says, geez, we're investing 100,000, and we're getting $140,000 back. But we're getting that $140,000 into the future where there's a discount of money. The value of money changes. And that discount rate in this case is 6%. So as you can see, that's a negative NPV. In other words, back to the drawing board. This is a key concept in capital budgeting. This is a key concept in stock and bond valuation, being able to determine the present value of an investment today, looking at its future return on investment. A very key concept of this corporate finance course. Another interpretation of this is to determine what is called the internal rate of return. Another concept of the time value of money. Formulas, function, financial, and now I look for IRR. There it is right there. This takes this future cash flow and determines the interest of return. This is the dollar return here. What is the interest rate of this return? So here under values, all we do is paint from year 0, in this case, all the way to year 10, the depreciable life, including the investment, and it gives us a percentage, 5.33%. So the return on this investment is 5.33%. Well, now we also know that this is a loser because we know our cost of capital is 6%. In other words, we know we have to be north of 6% to make any money off this deal. And this corresponds with the negative net present value. So these are two very important concepts in the time value of money that we'll be using in our class, determining in dollars the return on an investment into the future, and determining those dollars and what that equates into a percentage. And when we get to capital budgeting analysis, we'll determine how these cash flows are determined. We don't have to worry about that now, but this is a key concept of the time value of money. Another key concept is from our very first week of discussion, the risk and return, or the cost of equity. Remember we talked about this last week. It's the capital asset pricing model. This takes into account, as of today, what is the investor expected return on an investment. And remember, we learned the capital asset pricing model as being the risk-free interest rate plus the market premium rate times the beta of a company. Well, again, if we do that for this particular instance, and this is a little bit more real world data, the risk-free rate is 3.371%. That's with a beta of 0. The expected market return as of today is 10%, where that's an average beta or 1.0. And the company we're looking at here, the AA Corporation, has a beta of pretty good, 0.80, better than the market return. So if we put that into a formula, equals the risk-free rate, which is 0.03371, and to that we add the market premium, which is the expected market return, 0.10 or 10%, minus the risk-free rate, 0.03371, and multiply that times the beta of the company, 0.80, we will get our expected return today on our company with a beta of 0.8. And there it is, 8.67%. That's the expected rate of return off the equity of this company as of today, with the risk-free interest rate, the market return rate, and this particular risk of this company, AA Corp. Notice, because the beta is 0.8, which is under the market beta, the interest rate of return is lower. The market return, if you invest in a market with a beta of 1, you'll get 10%. But since this beta is a little bit better, meaning the company's a little bit more consistent in their returns, it's a little bit lower, cheaper. So again, this is the cost of equity that we discussed last week. Another way of taking a look at the present value or the current value of an expected return off the equity position of a company. And then finally, if we look at the tab for Chapter 5 in this worksheet that's posted in your Week 2 Blackboard, it talks about bonds, bond valuation. Now, again, in corporate America, most of the financing of corporations is done by the issuance of bonds. Why? Because they can issue multi-million or even billion-dollar worth of bonds. Because most banks don't have the reserves or the amount of credit. So a company like Apple Computer wants to do a new investment and they need $600 million to finance. JP Morgan can't finance that. Too big. It's too much risk for their company. So what either Apple does is consolidate or get a bunch of banks together to put together the 600 million, or they go to the bond market and issue bonds to the market, to investors, to pension funds, to individual investors, to insurance companies, and they will lend the money to Apple Computer. So here's an example of a bond, and all bonds are issued in $1,000 lots. So if you go to Wells Fargo or you go to your investment broker and say, I'd like to buy one bond, they'll say, okay, 1,000 bucks, please. That's cheap. Now, if you want to spend less than $1,000 on a bond, then you go into a mutual fund or invest in a mutual fund with other investors. Then you can buy into that fund at less than $1,000. But if I wanted to buy a single bond, $1,000 is the price. The coupon rate is the interest rate that that bond issuer will pay their bond buyers. In other words, if I invest $1,000, I will get a 10% coupon every year. And that's 10% of $1,000, $100. In this case, though, it's payable semi-annually, meaning we're going to get 2 payments a year, 5% every 6 months, which totals to 10, and a $50 coupon every 6 months. So that's our return. So we lend somebody $1,000. In return, we get amount of payments. Now this bond happens to mature in 18 years. Okay, so it means 16 periods. So 8 years. So over 8 years, every 6 months, I will get a check for $50. And at the end of those 8 years, I'll get my money back. All right, I'll get my money back. Well, let's say we decide to sell this bond prior to its maturity date. Let's say, I don't want to wait 10 years to get my $1,000 back. I need the money now. Can I go into the market and sell it? And yes, you can. The key to selling it in the market is how many more periods are you selling? In other words, how many more payment periods? And also, what is the current yield to maturity in the market of this bond? In other words, maybe some of you have heard this expression. If interest rates go up, bond prices go down. If interest rates go down, bond prices go up. And it all has to do with present value. You're issuing or selling a bond at a particular time period where the interest rates in the market have changed. So that's going to change the value of that bond for somebody wanting to purchase it from you, if you so desire, in the market. Another time value of money concept. So let's say we want to sell this bond after 2 years. So there's 2 years have gone by and we've gotten the $100 payments for those 2 years in $50 payments every 6 months. So at the end of 2 years, we want to sell it. So what is the value of this bond with 6 years remaining? And in this example, nice spelling. And in this example, the yield to maturity for an annual basis is 8.5%, meaning since this is a semi-annual bond, the market says this bond has a coupon now in the market of 4.25%. But you're going to be selling this bond, and whoever's going to buy it from you is going to get 10%. That's why it's attractive in a lower interest rate market. So let's see what that looks like. In other words, we're going to do a calculation using the formula, function, financial, and we're going to determine the present value of this bond today in the market, present value. All right. The rate in the market now is 4.25%. The number of periods remaining. Remember, we're selling it at the end of 2 years, 6 years remaining. That's 12 payments. Remember, this is a semi-annual payment. Each payment is $50. And its future value is at the end of these 6 years, you'll get $1,000 back. So what is this $1,000 10% coupon bond with 6 years remaining in a market that says the current yield is underneath the coupon rate, 4.25% per period? What is that worth? $1,069.38. This bond is going to be sold or purchased at a premium above its face value. Why? Because the interest rates are lower than the coupon, the market yield. Meaning that somebody who wants to buy this $1,000 10% bond in a market that says you only should get 8.5% is going to pay it at a premium. You're going to pay, who's ever going to buy this, going to pay $1,069.38. And in return, they get a $1,000 bond and $50 payments every 6 months. If they would go to the market today, they would pay $1,000 for a bond, but they only would get $8 and they would only get $85 a year instead of $100 a year, 8.5%. So you have to pay premium because this market says if I'm buying a 10% bond, you have to pay for it, a premium. Whereas let's take a look at another example. When the yield to maturity is higher, 12% compared to the coupon of 10%. That's the 6% per period, 6 months. So again, we do the same calculation. Formula, function, present value under the financial category. The interest rate now in the market is 6%. Same periods remaining, 6 years, 12 periods. Same payment, $50. And same future value, $1,000. Notice I put negative numbers in front of these numbers. That makes our ending number positive. So a 10% bond in a market of 12% is going to be at a discount, $916.16. So if somebody wanted to buy this bond in a market yield of 12%, they're going to pay $916, but they're giving up that additional interest. They're only going to get $100 payments per year, 10%, where if they paid $1,000 for it today, they would get $120 a year payments. So in this case, the market's changed for that particular bond. Its value is less because interest rates are high. Well, this is a key concept in corporate finance about how interest rates affect the value of an asset. If interest rates go down, this asset value, in other words, the bond, goes up. If interest rates go up, the value, of this asset goes down. And that's what we're doing today in our economy. Interest rates are going up. So existing assets, stocks, bonds, houses, whatever, are losing value because of that higher interest rate or higher inflation rate. When interest rates are low, like they were 2-3 years ago, many assets were higher value because the interest and the cost of money was cheap. This is a key concept in corporate finance, understanding that relationship of cost of money, interest rates, inflation to the value of an asset. So in summary, this second week, we've looked at from chapter 4, key ideas about the time value of money in regards to investments, the net present value or discounted cash flow, and the internal rate of return. What is my return in dollars? What is my return in a percent? Taking a look at the cash flows generated over that time period. And then we took a review of last week's issue in chapter 6 of the risk of the required rate of return using the capital asset pricing model, taking a look at market rates for no risk, average risk in regards to the specific risk of a company. You'll be doing this calculation plus others in your case number 1 for your company next week in the case. You've already calculated or got the beta of that company in your week 1 discussion. I will give you the risk-free rate. I will give you the expected market return. Your job is to tell me what is their current cost of equity or investor expected return. That's one of the calculations you'll be doing next week in case 3. And then we took a look at the introduction of bonds. What is a bond? What does it mean? And how interest sensitive it is as market rates change. And we'll talk more about that also in our Friday update video. There's one other tab here, which is chapter 7, which we'll include in our lecture next week when we talk about stocks. But this is a great but simple lecture notes, which is posted to your week 2 Blackboard. So we're off and running in week number 2, April 10 through 16, 2023. A good time period to study corporate finance with everything that's going on in the world economy, with high inflation, with the issues going on with Ukraine and the value of the dollar and the comings and goings of what's happening in Europe and South America and our relationship with China. A lot going on, and all this is driven and drives our economic rates, our capital rates, and everything we'll be discussing in this class. So if I have yet to see you, I look forward to meeting all of you this week in our professor-student meetings, and look for our next video to be on Friday, and also next weekend we will post our first case due April 23rd. Thanks everybody. Have a great week. We'll see you soon. Adios.